Hello, everybody. Welcome back to Everyday Saturday. I'm Matt Stahl, along with my partner, Brad Gatto. Brad, how you doing?
Hi.
Hi. Very simple today. So what we have in store for today is we are picking up where we left off with our book review of The Psychology of Money by Morgan Housel. Excellent book. We are taking it chapter by chapter, dissecting this and relaying it onto you.
So we've been at this for over a year.
We have.
We don't do it every episode. We dive in from time to time. There's 20 chapters. Today we are covering chapter 11.
Reasonable is greater than rational. Before we get into that, though.
Yeah. Subtitle: aiming to be mostly reasonable works better than trying to be coldly rational.
Dun, dun, dun.
Mm-hmm. That's coming.
What have you been up to before we jump into that?
I mean, married guy, kids, school, sports, busy, just business. Been doing all the things. This is the first year that we were season ticket holders for the Iowa Hawkeye football team. And so took a couple trips down to Iowa City to take in some games. Got to watch literally a historically bad offense. No joke. Like, Iowa was setting records that you don't want to set. Like, our offense is so bad, we're setting records. There's 130 teams that played Division I football, Matt. Iowa's offense was ranked 130th. So
isn't that crazy?
And they won 10 games. They won 10 games
in the Big Ten.
In the Big Ten. Well, the Big Ten West, which is kind of like the junior Big Ten, but
yes, it is.
Still, it's going to be all different next year. No Big Ten West next year, because we've got 4 more teams coming into the Big Ten. So there's going to be 18 teams in the Big Ten, because that makes sense.
It's going to be the Big 30 pretty soon.
Yeah, but it was good. It was it's always fun to it's one of those things where people like to hang out with people that are like them. You like to hang out with people that have the same thoughts and opinions and all those sorts of things. And so then you apply that to like a school and the fandom of a school, and you get into a stadium with 70,000 other people that are like, have this common thread. I don't care what that is. It could be college football. You could be at an AA convention. If everybody's there for the same purposes, like, it's just exciting.
Good energy.
Everybody should find something in life where there's 70,000 other people that like what you like, and then you should get together. It's fun. It's a lot of fun.
It's a lot of fun.
Just had that new realization for me.
There you go.
Find it. Find something that at least 70,000 other people like.
There's all kinds of things.
Like what?
Everything. There's 70,000 people in the world like underwater basket weaving.
Are they going to get together though and celebrate it like that?
That's a good point. I don't know.
That's see, what gets celebrated gets repeated. That's why they just keep playing. That's why it's so profitable.
You're just rolling them.
Let's go. How about you, sir? What have you been up to?
I've been watching some of the games. I did not go to any in-person games this year. I'm also an Iowa fan, and also just as surprised that they ended up in the
Tiger Hawk behind me,
Big Ten championship as anybody. But
yeah, I have no hope. I have none hope. No, I'm not.
Zero. When
they get destroyed by Michigan, and I'm prognosticating. We are recording this prior to the Big Ten championship. It is technically end of November. That game is in December. They will lose. You want to bet? Not bet. Let's both guess what the final score of the game is going to be.
Oh, sure. Go. You go first.
No, I was my question.
Let's see. I'm going to go 44-6.
I think the 6 is probably pretty accurate. I don't think the Iowa defense is going to give up 44 points. We had to play at Penn State on a record-setting day for attendance for Penn State. Over 110,000 people there. Night game, bad weather, hurt quarterback, and we gave up 31 points.
Yeah.
So I'm going to say 24-6.
Okay. So you're going with 6 as well.
Yeah. I think 6 is a great idea. Yeah. I don't think we're going to score a touchdown. I don't think we're making the end zone unless it's on defense.
Right.
Now, the caveat there is if our defense scores a touchdown, that's different. I don't think our offense is going to score a touchdown.
I agree.
So I'm going to say 24. You said 44.
I said 44. Yeah.
All right. Yeah. Handshake. Gentleman's bet.
All right. We have right here.
Should have done that. I'm sick. See, you lost already.
Oh, man.
Sorry, sucker. All right. Here we go. Reasonable is greater than rational. Matt, what in the world is Mr. Housel talking about?
Yeah. So I want to read the opening sentence or handful of sentences here. So You're not a spreadsheet.
Also known as a paragraph.
Yeah. Well, it's a short. Look how short it is. You're very short. You're not a spreadsheet. You're a person, a screwed up, emotional person, which kind of sets the tone for all of this. And when you think about this, when I think of rational, I think of what makes sense on a spreadsheet and what makes sense on, from historical data.
Yeah.
And reasonable is bringing the human element into that and how we feel about all those things and how that affects our actions. So,
yeah, he follows that by saying reasonable is more realistic and you have a better chance of sticking with it for the long run, which is what matters most when managing money. And this is true of most things in life.
Right.
Right. I always use kind of the anecdotal story of if I wasn't a financial advisor, but I was a dietitian and trying to help somebody stay healthy or, whatever that means to them. Could be losing weight, could be whatever. That the best diet you can go on is the one you will stick with.
The longest.
Well, yeah, I thought that was assumed. Sorry.
I thought it was a dramatic pause. So I was finishing it for you. So as always, or not always, but most of the time, Morgan offers some stories, which I think is really helpful and kind of ties it back to some historical events. And the first is Julius Wagner Yarog. That's how we're going to pronounce it. He was a 19th century psychiatrist. And he was really good at recognizing patterns. And he was also a little crazy. So,
well, and the bottom line is medicine's advanced a little bit,
just a bit
over the last 150 years. I was actually just listening to a podcast. This is probably 3-4 months ago, talking about in the late 1700s when we were just becoming a country, and in the early 1800s when yellow fever was going through like Philadelphia, which was the capital at the time, and what doctors were doing to try to treat it. One, they were giving mercury. Oh my gosh. Basically poisoning you, hoping that your body would
yeah.
And then bloodletting was another really big one.
My next.
Here, let's just take half your blood out and then hopefully, which today sounds completely ridiculous, but modern medicine, we've come a long way.
Do you wonder if there's anything we do today that we're going to think the same thing about?
100%.
Yeah.
There has to be, because it's everything from the way that we treat, things like medicine to thoughts around society and what's fair and what's not fair and how you treat other people and the way businesses grow and technology. 100%. Our grandkids are going to look back at what we're doing today and be like, unbelievable. I cannot believe they did that. So anyway, but the point of the story is this particular psychiatrist was trying to figure out a way to cure neurosyphilis, which was a big problem back then. Big problem because they did not have penicillin.
They had no known treatment whatsoever, and it was pretty fatal. So what he discovered was a hunch that was there that when you get a fever, that's a positive response to syphilis that allows your body to fight off that particular infection.
Yeah. So what he noticed was the people with this neurosyphilis, if they also had something else wrong with them that was causing a fever, that those people that actually had this double diagnosis of neurosyphilis and something else causing this fever actually had a greater chance of recovering from neurosyphilis than the people that just had the syphilis, no fever.
Yeah. And I think it's important to point out that some of the people, it says he actually injected them with typhoid, malaria, and smallpox to trigger fevers strong enough to kill syphilis.
Can you imagine? This is vaccinations, pre-penicillin, pre all this stuff. And he's like, dude, I'm just going to give you typhoid.
And some of the people actually died from the treatment itself. But what he did find is 6 in 10 syphilis patients treated with malaria therapy is what he called it.
Because he settled on malaria. Of all the things I'm going to give you a fever, because like you said, he tried typhoid and some other things. They settled on malaria. Should be the thing that which it's hard to even say in that. It's like
sounds logical.
Yeah, I'll take malaria.
So 6 in 10 people actually recovered as opposed to 3 in 10 that were left alone.
So in other words, the body's response of having a fever while you have syphilis allowed for a better immune response and therefore give you a better chance of living.
He actually won the Nobel Prize.
He did.
So
now fast forward.
Yeah. Hey, you stole me. I was going to fast forward.
We're both fast forwarding. So we know that his back then his assumption that fevers help the body fight infection. We now know scientifically that that's true.
Mm-hmm.
But
So, Brad, what if I said, hey, you're going to have a fever of 104 degrees for the next week, but it's going to help your body to fight off an infection? How are you going to feel about that?
not great.
Not great, but it works.
I've had a fever this week.
Yes, you have a fever right now.
And guess what I did?
Took some medication.
I took some drugs.
Yes. Why?
To get rid of my fever.
Because you're a reasonable human being.
Because I'm reasonable. And fevers are not great.
So what Morgan,
they do not feel great.
They do not feel great. So what he ends up coming to the conclusion is we know that a fever is a response that's actually going to help us to get better.
Let me say this, Matt.
Yep.
I would venture to say that most of our listeners know and have at least heard that your fever is there for a reason,
mm-hmm.
and that it's your body's response and it's a positive response. Yet most of them also do exactly what I did this week and take Tylenol,
right,
to get rid of the fever.
Because they're reasonable.
Because they're not thinking rationally,
mm-hmm.
they're thinking reasonably. And it's not, as Morgan says in the book, I don't think it's complicated. Fevers hurt, and people don't want to hurt. So if I can get rid of that hurt, the reasonable person is going to do that.
Right.
So there is this dichotomy between what's reasonable and what's rational. Going back to the very beginning of the chapter, he starts by saying, you're not a spreadsheet. A good friend of mine, mentor in this industry, actually wrote a book called Life is Not Lived on a Spreadsheet. And so I've used that saying for a very long time because of that gentleman. And it comes through here when we're making decisions. So how do we tie this back into what we do for a living? Personal finance, financial planning.
Yeah. So he suggests that we take that same philosophy and take it to managing our money and managing our decisions. Jeez. So you and I were talking about when someone comes into our office and, well, let me give you a scenario. So I think this has probably happened to you before. Someone comes into your office and says, I don't know anything about anything. Just tell me what to do and I'll do it.
Nobody's ever said that.
Nope, never. Right.
It happens a lot, right? We're big on education here. If you're somebody that is currently working with Fiat, you'll know our process of onboarding is very extensive. We ask a lot of questions, and sometimes in that process, people get a little impatient. And sometimes they're just like, you know what? I don't care why you're doing what you're doing. Just do it. Just do whatever you're supposed to do. Which what they're saying to me is do what's rational.
And how does that play out? Build
my financial plan on that spreadsheet. Stick to the spreadsheet. It usually works for a while.
Right.
Just like the person that goes on the diet of eating food they hate, but they know it's what's good for them. And so you can white knuckle that for a while.
Right.
And it's usually when something bad hits. In the diet scenario, something bad would be like you see ice cream. That's what happens for me.
It's waiting for the personal reference.
Yeah. But in the financial planning world, typically what it means is the plan goes sideways.
Right.
In the short term.
Big market correction.
Something like that. Then all of a sudden the reasonable comes to play because the rational is not working, right, or for them anyway, because it's not reasonable.
So the rational side would say, hey, look at this spreadsheet. Look at these historical performance numbers. Everything's going to bounce back. The reasonable side is saying, I'm not able to sleep. I don't care what you tell me.
Yep.
I'm not comfortable. Right.
Yeah, absolutely. I mean, so when you think about starting your financial planning process of like what you want your money to do for you, your financial goals, all this other kind of stuff, it is very important to think backwards. And we talk about this a lot. We actually talk about thinking opposite a lot because we work with a lot of people that are trying to figure out how to spend their money, not save their money, which seems like it's the opposite. This is another place where you don't start with the spreadsheet. Don't start with the numbers. You start with how you feel.
Right.
And what you deem is reasonable. I think one of the best examples he gave is in our industry, Matt, there has been a lot of studies done on investing and the spreadsheet side of investing. And what most financial advisors in this industry have been trained on as far as giving good financial sound portfolio construction advice is a theory called the modern portfolio theory.
Yes, sir.
Which was invented by Mr. Harry Markowitz, also won a Nobel Prize.
Yes.
A lot of Nobel Prize winning people we're talking about today.
Yeah.
When are you going to win yours?
20 years.
Okay. Another prediction. So I was going to lose the Big Ten championship, and Matt is going to win a Nobel Prize in 20 years. Oh, I love it. Put you on the spot there. So Harry Markowitz, modern portfolio theory, which was this, on a spreadsheet, exactly how you should invest money. He was interviewed, and in this interview, he was basically asked how he came up with his own personal money portfolio and the design for his own personal portfolio. And here's what he said. I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. My intention was to minimize my future regret. So I split my contributions 50-50 between bonds and equities. Now, to the untrained ear that does not know what modern portfolio theory is, the spreadsheet side of this, that is not it.
That's not it. No, not even
so
close.
The guy that created the spreadsheet for how Matt and I and our industry hypothetically are supposed to build and maintain investment portfolios is not following his own spreadsheet.
Right.
Why?
Because a rational investor makes decisions based on numeric facts, but a reasonable investor, there's a whole social element to this as well. So,
because what he realized when he thought about it for himself is, I can't follow the spreadsheet. I'll never make it.
I won't sleep.
Yeah.
Basically, right? The second piece of the interview that I want to go through that he said, my own view is that people are neither rational nor irrational. We are human. We don't like to think harder than we need to, and we have unceasing demands on our attention. Seen in that light, there's nothing surprising about the fact that the pioneer of modern portfolio theory built this initial
struggle bus today
with so little regard for his own research. Nor is it surprising that he adjusted it later. That's Jason Zweig, who actually conducted the interview with Markowitz originally. So he's not rational or irrational. He was just making a reasonable decision.
So all that to say, if you're the guy that has built like the quintessential spreadsheet and you've got it all figured out on a spreadsheet.
I like how you said, you're the guy.
Well, you are a guy. I'm talking about like you.
I know.
The collective you can also, be whoever.
Yes.
Gender neutral term. Okay. Is that fair?
I'm just saying, stereotypically, it's usually the guy that thinks he has everything figured out.
I see where you're going there. You're right. The male ego is a very powerful thing, is what you're saying.
Yes.
We got there. It took a second.
Yes.
But we got there. Bottom line is, he himself, I don't know that I would be curious to know if when Markowitz went down this path of having this conversation in his head of if the market went way up and I wasn't in it, how would I have felt? If it went way down and I wasn't in it, how would I have felt? If he consciously or subconsciously was trying to build a reasonable portfolio for himself, or if he just was like this subconscious of like, well, I figured out on a piece of paper what you should be doing. I can't do that.
I can't do.
I'm not doing that.
It's not reasonable.
Yeah. An extreme example that they gave in here, even more so than Markowitz's modern portfolio theory, is a study done by some students at Yale that basically figured out that if you're in your 20s and 30s, not only should you be in pure equities, you should be leveraging those equity positions. And so for every dollar you have to invest, you should be investing $2. In other words, you should be taking out debt to invest more money than you have.
Because the math works out on paper.
Because the math works out on paper.
Historically.
But Matt, what that means is if you have $1, but you invest on margin. So in other words, you took out debt. So you invest $2 for every dollar you have. And then 2007 to 2009 comes along. The S&P goes down over 50%. That means you, the leveraged investor, just lost 100%.
Zero.
What are the odds that you're going to keep doing that?
Pretty low.
I'm going to say zero.
Yeah.
Very little. Now, in their spreadsheet, you would have to keep playing that game. And if you keep playing that game, you will eventually end up winning.
Odds are, right?
Odds are. but it's not reasonable. Nobody's reasonably going to do that.
No.
They may start it, but they're never going to finish it. It's the same reason that, like, when you go to a casino, I'll put you on the spot here. There's one game in the casino that the odds are in your favor. Do you know which one it is?
Blackjack.
Blackjack. And as I understand it, it's 51-49, assuming you play by the book and you never go against the book. But the casino consistently doesn't lose at blackjack, even though the odds aren't in their favor. Because, you know, the casinos play thousands and thousands of hands of blackjack every day. They play it every day of the year. They play it for years on end, decades on end. So why doesn't it eventually work out where the casino actually loses money?
Number one, numbers are on their side. Number two, it's humans. They know they're going to
Because we don't go by the book.
Decisions, right?
Because we do what's reasonable,
right?
Not what's rational. We make emotional decisions for us and how we feel. Every time you're sitting at a blackjack table and the guy sitting next to you doesn't hit his 16 and you're like, oh, dude, you're by the book, you're supposed to hit that. And because you didn't, now the odds are back in the casino's favor and you've screwed it up for the rest of us. The casino knows that if there's 8 people sitting at the table, somebody is going to go against the book because we're an emotional creature and we're imperfect. So, great example there. He also gives another example here later, which I think is, you know, I don't know why I take joy in this example.
It was kind of shocking. I was actually excited for you to read it.
I think the reason I take joy in it is because it's, and this is fully transparent. Okay. So this is getting real. This is like some Oprah stuff. This is like some Oprah stuff going to happen on this podcast. As a fiduciary financial advisor that gets paid for my advice. We get paid for our advice. And on top of that, we do some active investing, not just passive investing. The champion of DIY passive investing is who?
Jack Bogle.
Jack Bogle, who started what company?
That would be Vanguard.
Vanguard. Wonderful human being, great contribution to our industry. We use Vanguard. I have nothing against it, but he is the champion for the average DIYer that would look at our industry and go, not worth it. I'm going to do my own DIY, passive investing, never going to do anything else because on a spreadsheet, I think that that's what makes sense. That being said, there's a story in this chapter about Mr. Bogle. Matt, why don't you share?
Did you know this?
I did not.
Okay. So Jack's son, the son of the infamous Jack Bogle, he actually went on to a career as an active high-fee hedge fund and mutual fund manager, which is the complete opposite of
the complete opposite.
Complete opposite.
That's like John Bogle being Mr. Ohio State and his son goes to play for Michigan.
Yeah. His entire
we're back to Big Ten
career,
football.
Everything was built. Yeah.
Anecdotes here. That probably doesn't land super well with a lot of people, but the competitor, it's like the opposite.
Not only did his son go on to do that, but the second part of this is he actually invested money with him.
Mr. Vanguard invested some of his money with his son at this highly actively traded, very expensive hedge fund.
And I want you to share the quote.
We do some things for family reasons, Bogle told the Wall Street Journal. If it's not consistent, well, life isn't always consistent. That was his response. So long story short, this idea of reasonable and rational. So Matt, how do we what does the average listener take from this? Why should they even care? Why is this important?
Yeah.
And what should they do about it?
There's one word that comes up that we just mentioned earlier before we jumped on the podcast. I think there's one word that can describe all of this is endurance. What is going to give you the endurance to stay involved and stay engaged? And that's normally going to be something that's reasonable as opposed to rational. So if you're somebody that,
let me pause you there just real quick, because why that's so important. And I
Mhm.
know you've all heard this, but I'm going to just do it again.
Yep.
The historical odds of making money in the markets and investing money on a day-to-day basis are 50-50. So if you're going to get in and get it out every single day, you got 50-50 chance. Over a 1 year period, if you're in for 1 year at a time, there's a 68% chance you're going to make money in that year. 32% chance you won't. If you're in for 10 years, there's an 88% chance you're going to make money. And if you're in for 20 years, there's so far anyway, 100% chance that you're going to make money. And so why is endurance so important? Well, because it just increases the odds of success. The longer you can stay, the greater your chance of success. And so you have to figure out, one of the key things you have to figure out is, how do I stay?
Right.
So to stick around.
Yeah. So if my risk tolerance, if I'm somebody and my risk tolerance is extremely low and I'm watching the market and my advisor tells me that I should be in 100% equities, 100% stocks, because that's what makes sense. But my stomach is turning every day. I'm not sleeping. I'm probably not going to stick with that.
Yeah.
That's not endurance, right?
Yep.
And that's probably not a rational choice either. If I'm a 25-year-old and I have time on my side, but a reasonable choice is something that I can live with.
Yeah, but the devil's advocate to what you're saying is, and this is the problem too with people talking to multiple advisors sometimes, or just talking to multiple people, even if they aren't advisors. You're talking to your neighbor, and then you talk to your cousin, and then you talk to your father-in-law. They're all giving you a little bit different advice. It's based on what they think is rational.
Right.
Or maybe even they're adding in some of their own reasonable piece to it, which isn't reasonable to you. Looking at a 25-year-old that wants anything other than equities, you cannot justify on a piece of paper.
Right.
Just on a spreadsheet. But knowing that, let's just say, as an example, what is reasonable is to take them down to bonds because they're far less, they're far less volatile. But we know, you and I both know on a piece of paper that historically there's a 5% spread between equity returns and bond returns. And so we know they're giving up, again, historically about 5% return. That's significant for a 25-year-old. But I would argue, here's the devil's advocate. They're probably going to do worse in stocks, an all stock portfolio, than they would in bonds, because if they can't stay in and they go in and they go out, they go in and they go out, they're going to underperform a bond in their equity positions because of it not being a reasonable recommendation for them.
Exactly. And beyond that, it's a conversation. Maybe they end up in some stocks and some bonds, but it ends up being a reasonable decision based on the facts that are in front of them and knowing that they want to sleep at night and what's going to give them that endurance to keep going. Yeah.
I actually just had a visit this week with a prospective client and had this exact conversation, and it was about an annuity, which is a very controversial, product or solution in our industry. There's a lot of opinion on it, and probably a more diverse set of opinions as far as like super positive to super negative. And the conversation I had with them was this conversation. It's not rational for you. On paper, you shouldn't do this. It's reasonable, because everything that you're telling me about how you feel about risk and what you want your money to do for you and all this kind of stuff, this is the reasonable thing to do. This is the Tylenol when you have a fever. Even though technically I can prove to you that your fever is good for you, I'm giving you the Tylenol because I know that's how you're going to stay the course.
Right.
And it's hard to do that sometimes because everybody wants the spreadsheet.
Right.
Yep. We do.
Yeah.
Because you want efficiency. We all want max efficiency. I want to be the best, and we compare ourselves. Like it's funny how, whatever you do in life, whatever job you have, you compare yourself to your coworkers, the place in which you live. You look at your neighbors and you're like, how do they have that? What do they, their house is bigger than mine. Their car is faster than mine. We do it with the markets too. And with our, the way that we invest, and we're like trying to race everybody around us. When in reality, if they are getting in a sports car to go 100 miles an hour and you would never drive 100 miles an hour, you're never going to win that race anyway.
Right.
But we buy the sports car thinking I have to do that to keep up with them, and then don't use it the way that we should use it. And that's how we end up wasting time, money, effort, all that kind of stuff.
All right, let's tie a bow on
it. So the call to action, the cut, there's a long pause there. So after where did I end there?
Sports car.
What are you going to, so how do we wrap this up?
I think we just bring it back and say, whatever's going to give you, I mean, we've kind of already said that, but.
Oh, yep. So you can ask that question now. Like, I'll count us down to our, what did they call it when I was doing my audiobook? They called it the punch. Here comes the punch. 3, 2.
What am I going to ask you? How we tie a bow on it?
So Brad, how do we bring this back? Practically speaking, what should?
All right.
people be thinking? What should they
Yep.
be doing?
All right, here we go. 3, 2, 1. So Brad, practically speaking, how do we bring this back? What's an actionable item?
Well, we need to have financial plans that are reasonable, first and foremost. And so one of the ways that we do that at Fiat is we just ask a lot of questions. We try to figure out where your comfort level lies, what's going to help you. We call it the sleep at night factor. We talk about that all the time. And I cannot tell you how important that is. And these last couple of years, Matt, have kind of played that out because we had the COVID pandemic. That was a scare, not just on an investing standpoint with the market crashing over 30% in a matter of a month, which was super scary in the moment. But also the health scare, just kind of what was going on at the time in our country and around the world. And then last year, if you were in the rational portfolio as a retiree, you were somewhere around 60% stock, 40 bond. And 2022 was historically the worst year for that portfolio since 1937. And so these last couple of years should probably have told you if your portfolio is not reasonable for you. Because if this stuff is freaking you out to the point where you think you need to make major changes or you need to get out of the market or whatever it may be, it's telling you that you're not being reasonable and that you're trying to white knuckle your way through a rational portfolio. And that will not, that endurance can last for a while, right? And you'll make it through part of the race, but you will not make it all the way. And so building a reasonable portfolio, if you've never tried to connect those dots, we can try to help you do that and help you figure out where your goalposts are. We use the phrase all the time, there's no true freedom in life without boundaries. Figuring out what your reasonable boundaries are is super important. And that is just part of the process here at Fiat. This is just built into what we call our retirement renovation process. And so we'd love to help you figure that out if you have not already.
Awesome. Reasonable is greater than rational.
There you go. Thank you, Mr. Housel, for this book. Thank you for that chapter. It's probably a chapter we could read every single week and use as a reminder to ourselves. Right? With that being said, thanks for joining us for this episode of Every Day is Saturday. As we said before, my name is Brad Gatto. This is my co-host, Matt Stahl. Thank you for joining us. If you want any more information on this podcast or anything else Fiat, or you want to go through a process that's more reasonable than rational, you can get a hold of us at our website, fiatwm.com, FIATWM.com. We will see all of you next Saturday. Bye, everybody.